Why income changes the way risk feels. Early in an investing career, growth feels like the goal. You measure progress by account balances, by appreciation, by upward movement. But at a certain point, something shifts. Risk doesn't feel the same anymore. And that shift usually has less to do with age and more to do with responsibility. When your portfolio is designed primarily for appreciation, every downturn feels disruptive. You're relying on market performance to move forward. You need recovery to stay on track. That works well in accumulation years, but once your portfolio becomes connected to lifestyle, retirement, or legacy, the experience of volatility changes. It feels personal. Income changes that experience, not because it eliminates the risk, not because it guarantees the outcomes, but because it buys time. When a portfolio produces cash flow, you're not forced to sell assets to generate liquidity. You're less dependent on short term price recovery, and you have more flexibility in how you respond. Income creates breathing room, and breathing room changes behavior. Most investing mistakes don't come from bad intelligence, they come from pressure. Pressure to act, pressure to adjust, pressure to protect. Income reduces that pressure. It shifts the focus from what's my account value today to is my portfolio functioning? That's a very different mindset. This is one reason institutional investors often prioritize income producing assets, endowments, pensions, long horizon capital. They aren't trying to maximize upside every single year. They're trying to ensure continuity. They design portfolios to keep functioning regardless of headlines. Assets tied to real demand, housing, storage, production, energy, often generate income because they serve ongoing needs. People still need housing, businesses still need space, energy is still consumed. That doesn't remove risk, but it anchors the investment to usage, not sentiment. And that anchor matters during volatility. Over time, many investors realize they don't just want higher returns, they want fewer forced decisions. Income first thinking doesn't replace the growth, it balances it. And that balance changes how risk feels. You don't feel you have to abandon appreciation strategies, but you do need to ask yourself if markets stalled for a few years, would your portfolio still function? If the answer depends entirely on recovery, that's worth thinking about. If this perspective resonates, I explore it further in The Crash Doesn't Announce Itself, where we look at how structure and income reshape long term resilience. Click the link below to get your copy.